Test. Okay, here we go. Test, test. Let me know y'all can hear me. Maybe do a screen refresh. We should be good to go. Alright. Alright. Who's excited for tonight? Come back from vacation just for you guys. It's because I love you so much. Alright, so we're going to cover a few things tonight, mostly on divergence. And so let's get underway. If you're brand new tonight, we're going to be covering divergence as seen from the harmonic scan perspective, and then specifically quickfire on those 15-minute scans. Okay, so we have a updated group shot here, so everybody should take a screenshot of this, especially if you're brand new. If you're brand new, please take a screenshot of this. It highlights our group, our Facebook group, which is iMarkets Live Scans, Forks, and Fibos. We have a group Telegram channel, which probably won't start up until after Christmas. I think I made 1 or 2 posts to it so far, but it'll be daily once we get past Christmas. But it's in the pinned post at that group. There's a free Pitchfork course for IML members only. There is the link to it, and there is the password. The login, lowercase IML. The password you can see there. Case sensitive. So again, keep a screenshot of this. There are web scanner alerts available. It's an optional. You get a 10-day trial, and then it's $2.99 a month for 15-minute scan alerts. So if you want to be alerted via a telegram on your phone or on your desktop versus a text or an email, keep it separate. You can go to the pinned post and look up for the web scanner alerts. Finally, there is a Forex Traders calculator which does position sizing and a lot more things there. So I ask you to grab a screenshot of this now. I will put this up at the end of the session tonight as well. Welcome to you guys who are first timers and or first timers live. So several weeks back we did the quickfire Charlie Delta training. If you're brand new again and you're interested in scans, I encourage you to look at that. The link to that video is in again our group in the pinned post, and you can scroll down and see the quickfire Charlie Delta training video. It was followed by a little quick overview of divergence, or a update on divergence, because there were some questions to it. I'm going to delete that divergence video and replace it with this one. So I encourage you to take advantage of this. So the session tonight, let's see here, we have our Pip Club traders here. We've got Charlie Delta 10 group here, which are special IML traders who've opted to dive into some very specific stuff, including waveology. And then we have our general IML audience. So there's going to be a few places in here where there may be some overlaps between those groups, but this very first part really is for everybody. So with that being said, let's talk about divergence in terms again of quickfire, in terms of the scans and the way to measure it. I'm going to jump back to the quickfire training video where we get down and we start talking about the criteria and the third one being the MACD, the Bollinger Band hit, relative strength, and the MACD. And again, the MACD, as established here, is the 310 oscillator, and you can find more about the 310 oscillator in the Power of Oscillator Cycle Combinations. You can search for it and find it as a PDF on the internet probably, or if you prefer to pay $171.51 or 50 cents, you can get it from Amazon. This is quoted by Christopher Terry as he's teaching how to trade harmonic scans in general. So instead of the MACD with its normal defaults, we use the 310-16 setting. All right, so we covered that in quickfire. Then we talked about, okay, the general criteria for quickfire from a 15-minute trade. Does price touch the green line, the green entry line? If no, then we don't have a trade, okay? Does price touch or go past the first Bollinger Band? Again, we have setups for quickfire. If you're new and you don't understand what quickfire is, there is a training video on it. Does RSI go above 70 for a sell or below 30 for a buy? And third, is there divergence between price and MACD? Note, you only need any two of these three for the general patterns. It's only until you get into the two-line patterns, like sharks, that you would need to have all three of these criteria met. But then I started going through the differences between MACD on a MT4, because we had some people on MT4, and how the indicator and the settings for it was a little confusing because they don't use the same names. You know, somehow we have a fast EMA, a slow EMA, and a MACD, and then it turns into main and signal over here. A brand new person may get confused as to what this really is, but nonetheless, it then transitions itself into a plot that would look like that when you have the 3, 10, 16 parameters filled in. Then we looked at trading view. Little different orientation, still have fast and slow, but now it says source. Signal smoothing, interesting. And then we go to the style, and again, different names for everything. So I'm not sure why they can't have consistency there. And the resultant plot, you know, a little different. When we see it on a full-blown trading view chart, then it looks like that. Now, for most of you in here, I don't cater a lot to MT4. If you trade MT4, that's your prerogative, your choice. We're using mostly TradingView as an upgrade to what is the web scanner, because most of the traders in here want to trade the web scanner. If you want to trade just MT4, you can still follow along, but again, we're catering to the traders who want to trade the web scanner without having to have MT4 set up. And in that case, the web scanner is built on TradingView, so we're going to show stuff, you know, on TradingView here. Yes, we're referencing the D point of the scan. So this was a slide just to show that if you have divergence on one of the indicators that should show divergence, you should have them on at all. In times when that doesn't happen, I would reconsider the trade if you need divergence as a qualifier. If you can get by with the Bollinger Bands and the RSI, so be it. But you really should be able to see divergence, whether it's TradingView or MACD on an MT4, you know, the 310 oscillator on an MT4, or whether you're looking at RSI, or whether you're using stochastics, specifically with an 833 setting. And all of those should show divergence to this, you know, within plus or minus in the same magnitude. When you get differences, then I would really question what's going on, because for the most part, you need to see unanimity in these. I'm not suggesting you need to put all four of these on your charts and to measure all four. I'm just saying some people have in the past used RSI. So then we talk about, you know, inside the quickfire trading, the execution, and, you know, does price hit the Bollinger Band? Yes. Does RSI go above 70? Yes. Is there a divergence between price and MACD? Now you'll notice how I measured it here on the right. We're measuring it on the 310 oscillator, and we're measuring it on the short cycle of the channel, the CD channel. Okay, not back to X, but inside the CD channel. We're looking at higher highs, and so because we're in an up move, we would put our divergence on top of the channel of the prices. We would put our divergence on top of the histogram in that same stretch. And again, when we can see opposing opening or closing of these lines, we have a divergence that's, in this case, a reversal. So there's that chart which shows the principal reversals here, the continuations over here, hidden continuation divergence. And then there's classes. Class A is the most dominant. That's there. And that's the one we're going to focus on. I show the others just so you have it as reference material. And also note at the bottom, stochastics at 833, MACD is the oscillator, 31016 oscillator, and RSI 14 are all good for measuring divergence in trending markets. All right, so let's start with all that as background, kind of catching up to where we were, what was taught in the quickfire training. There still seems to be some confusion on the charts and trades. And so, I got to bring a little teaching and a little psychology and a little attitude all wrapped up into one. So we know that my position on demo accounts is they're for learning, they're not for winning. I.e., yes, you would like to win in your demo account, but we're not establishing our head game for that. Our objective in learning to trade in a demo account is that's our experimentation, that's our laboratory. And so we don't take the old paradigm perspective of, I've got to win this trade, and, oh, I took 2 trades and lost, woe is me. We don't want to have things affect our head game and our RIS in trading. Demo. Later on, once you've got demo and you've got the KSP, your knowledge of system performance, and you're nailing trade after trade after trade, that's when you can have what I call a little challenge set where you establish a brand new demo account, go take 50 trades, and you better win 40 of them before you think about going live. So many of you are too impatient. 2 or 3 demo trades. Oh, I'm ready to trade live money. So with my teaching of the demo account being for experimenting and whatnot, and you're not out to win, you're out to learn, that also doesn't mean you can repeatedly make the same mistakes. And I'll tell you the attitude that's wrong. If you're trading something like quickfire, where you have a hard set system and it's objective, okay, does this happen, does that happen, etc. You really, I'm just being honest, you don't belong taking demo trades unless you know how to use that criteria. And that doesn't mean you're trying to win the trade. It means you at least know what you're supposed to be doing. So a lot of you are first of all, not following the teaching in the video and in the supplementary video on divergence. You're kind of just hanging out there. And it's either because you didn't watch the video enough, or you didn't take screenshots of it, or you didn't take notes, you didn't watch the follow-up video, or whatever. But I'll be honest, the Grizzly Bear will come out and say there's just really no excuse for at least not measuring divergence. Maybe you measure, to somewhat of a in the range of what we should be doing, because at this point it's been taught too many times. And so if you're out demo trading, yeah, we're not out to win, but at the same time you're gambling. Because if you don't know what you're doing with divergence and you're still taking trades, that's just not right as an attitude. That's going to bleed over to your live trading someday. You're planting the seed for that in your subconscious. So I'm here tonight to finish off, the training on divergence. And this group has had enough. There's it taught in the quickfire, and now we're going to have this video, which is going to be really complete. And so, I hope you're paying attention now. Obviously, you'll be able to, watch the recording. And I'm trying to do a simultaneous record. I don't know if it's going to work, so we'll see. But nonetheless, this is my last effort on divergence. I have too much more to cover. I can't spend 3-4 months on divergence. And so I'm going to give you the tools here so you can do it and do it right. And if you elect not to, that's just your choice. It's okay. But it's going to affect your long-term trading ability. So let's take a 15-minute bearish harmonic scan. Now look, I didn't copy this off my charts or the scanner. I just freehand drew it. So if some of the dimensions are not right, don't be too critical about that. It's just meant as a, I won't say a cartoon, but it's just meant as a sketch of a harmonic pattern. We will put it to use, but nonetheless. So this is a 15-minute pattern. Now, what I've been saying in the previous teachings on divergence is you have to measure divergence inside the channel of your price move. Which means if I'm trying to see where the D is reversing, what I'm really looking for is the D reversing in that blue channel. Let me say that again. I'm looking for D to reverse inside that blue channel. And what I want to measure then, see if my drawing tool will work or not. It may. What I'm trying to measure then is, as we're moving up in this pattern, which one of these progressive highs has enough strength compared to the previous one to be considered essentially an RSI, overbought, or compared to the previous one, do I see divergence? And therefore we know which one of these to take. No divergence, no divergence. Oh, we finally have divergence. So it's this high, out of all the potential highs that we're working up here, this is the one that has a high percentage chance of reversing. What that means then is we couldn't possibly go back, let's say, to the B, because the B's not even in the same channel. So we can't come back to the B to measure divergence. The B would be a matter of the same thing we're looking for here in terms of this channel of A to B. Which one of those highs is the one that would be measuring divergence at that local level to see, oh, here's a reversal point. Now it should move down in a new channel. So going back to B would be, I hope you see here what I'm saying is it has no relevance to the D point. Does everybody see that? If we're looking from C to D in a blue channel, we want to know which one of these highs is going to show up as divergent. So the B has nothing to do with that while we're looking at this level. Likewise, going back to X has no relevance at this time frame. Because again, the X has its own channel on the way up. And as price was moving up in that channel, that X point, becomes the one that actually has divergence in its channel compared to a previous high, Oh, it's divergence. We're going to have a reversal. So now, some of you may come from other teachings which talked about the X, going back to the X to measure divergence for the D high. And here's what I want to say about that. I'm not saying it's wrong, but as I take you through tonight, you're going to see why you don't want to do it. You can measure divergence there, but not for this time frame. So what I want you to see here is the actual W pattern. We have W's and M's. That's what the scans are. And in each leg of that, it's a channel. It's a price channel. And if you want to measure strength in an individual channel, there you go. So we don't want to think about coming back to the X. We don't want to think coming back to the B to measure divergence here at D. We want to find the highs in here on their way up to the D, and that's the one we want to use. Not this, and not this, but this. All right, so let's look at this. Bearish patterns. Let's talk about the left side. Bearish patterns. The CD leg is an up move. For up moves, we wanted to measure divergence on the tops, the top of the price channel and the top of the histogram channel. Or if you're using RSI, the top of the RSI channel. If it's downward as a bullish pattern, now when I say over here on the left bearish pattern, you go, well, how is that bearish pattern? It's moving up. Because just as the little tiny arrow in the center of the page here indicates, price is moving up, it's going to be bearish at D and create a reversal. Likewise, on a bullish pattern, it's going to be a down move to the D, and then we're going to move out of there bullish. So this is a bullish pattern, this is a bearish pattern. In the bullish patterns, on the way down, because it's down, a down move, we want to measure it from the bottoms of price and the bottoms of the MACD, or your RSI. Now, where there's some confusion on that is because some people are familiar with channels, trading channels. And in trading channels, it's the exact opposite. You want to do your buys from the bottom, because that's where your strength is. And you want to do your sells from the top, because that's where your strength is. As in pitchforks, trend lines, etc. So don't confuse the two. I'm saying right here, there are two different things. Trading and measuring divergence are exact opposites. Know which is which. Again, at this point, it's a pretty element for people that have been here with me since the beginning. You brand new folks, I get it, you're brand new. But the guys that have been with me almost since the beginning, we're way past the time for you to be getting these two things confused. It means you're not taking notes, you're not taking it seriously, you're just out there doing whatever. And so you need to be getting this right. Now, how you use the technique, that's where we'll help you. That's where you're going to have some learning time. But knowing whether to measure tops and bottoms on a bearish versus bullish pattern, that's just where you should have that down by now. In case you don't, we're okay as of tonight. Okay? As of tomorrow, you better have it down. How's that for the grizzly? Oh my. So let's read this down here. Divergence is measured within the price channel in a 15-minute pattern. The swings you are interested in are in the CD channel. You are interested in the final swing in that channel as the reversal of that channel. This is why you should not go back to B or X, as they are not in the CD channel. The XD is an okay divergence measure at a higher time frame where the entire pattern, X, A, B, C, D, is all in one price channel. If CD is an up move, you measure divergence from tops of price and tops of MACD. If CD is a down move, divergence is measured from the bottoms. Do not confuse trading with which is the opposite. Down moves you sell from the tops, and up moves you buy from the bottoms. Get clarity on why you measure divergence one way, not on, one way, and trade another. Any questions about that? Okay, I think we're good. I'm going to move on. If you have a question, there's just lag, go ahead and type it in. All right, so once again, we have our 15-minute harmonic pattern. Now watch what we're going to do with this. We're going to take that 15-minute pattern and we're going to move it up. See, I'm going to explain why on the B and X. And I'm telling you, everybody should be crystal clear after this. Even the newer folks should get this to some extent. Newer to this group, not necessarily brand new traders. We're going to take this pattern and we're going to move it to an upper level. Okay? We're going to move it to an upper level. Or we're going to view it from an upper level. What do I mean by that? Well, remember, when we first started drawing pitchforks, we said find a swing low, swing high, the better fit it is, whether it's traditional or best fit, good solid to the pip touches. And if you have that channel and it's existing and persisting, a scan will appear in that channel. Remember me saying that? All right, so let's look at this. Boom. There's our 15-minute scan inside a pitchfork. Take a good look at this graphic. I'm not going to tell you that I spent 4.5 hours today on my vacation creating these slides for tonight. Because if I did, you guys would have too much guilt. No, it's because I wanted to have the de facto training on quick-fire divergence, and this is it. So it was worth the investment of my time to get the slides to express what I want to express. There's our 15-minute. Quick-fire is a trading strategy. It's available in the pinned post at iMarkets Live Scans, Forks, and Fibos Facebook group. If you weren't here at the first 5 minutes, I'll put that slide up at the end to show you where you can find everything. All right, so here's our scan inside a pitchfork. Now, look, I made it convenient so the C actually touched. That doesn't have to be, but I did want the X and D to touch on this pitchfork. And there's a reason for that. Yeah, it was more like 4.5 hours, to be honest. It was about 6, but I cooked some dinner for me and my son and checked the mail and, that kind of stuff. Yeah, I'm not going to tell you. So, what do you see about this? So you want to be thinking about what I was saying about the lower level channels, the W channel itself, which is at the 15-minute level, the X to A, the A to B, the B to C, and the C to D. Those are all channels. Now we're at an upper level, and we have an upper level channel. This is no different than, let's say, the CD move. It's just we're seeing it scaled up. This is no different than any other move, except it's scaled up. So, what's happening here with our pitchfork is we had a blue pitchfork coming down as a channel. Let's say it was the big move. I can't make it but so big with these lines. They don't let me make big lines here. So it was a big move coming way up there. And this is like what? A retracement of that big move. What would we look for on that big move? Oh, something like a resistance and energy point at that point at these points on the pitchfork. Maybe a 38.2 from the big move down. 4 hours. 4 hours. If it was 4 days, there'd be a PayPal link in front of the sign up. It was 4 weeks. No, it's been 4 months. I started this way back when I started IML TV. All right, so this is just a piece of the move. So let's look at the definition as if this was a bearish crab. Statistically, it's a counter trend pattern. So its ideal location is an uptrend near resistance. It signifies the start of a correction or a trend reversal. It may also appear at the end of a higher time frame correction of a downtrend. In such case, this pattern may mean the end of the correction and the start of the new trend leg. I colored it in red because that's exactly what we have going on with these arrows. All right, enough of my jokes. You guys stop chatting, please. So, big move down, correction up. This is just part of that move. So, note this upper level time periods channels, the blue and the black. See how the lower level 15-minute pattern in its entirety fits into the channel. Now, the C may come farther down, it might be shorter, but the pattern itself fits into this upper level channel. All right, Forex Essential. See, what you should do then is leave now and go do what you want to do in the group. Don't sit here and looking at it now while I'm trying to teach, and you're talking about it while I'm trying to teach. So you guys are here, pay attention here. That group and the data in it is going to be here after this class as well. So, but realize the MACD for this upper level period and the MACD for the 15 period are not the same. So if I have a bigger level wave like this, this is where I want to use the XD for divergence because it's in the same channel. And I want to know which of the highs in that upper channel is the one that might be ready for reversal, and we use MACD divergence to measure that. Do you see the difference of when it's appropriate to use the XD and when it's not? That's a yes, no question. That's what the chat box is for. So here's where you'll get the proper measure and relationship between the XD move and your measure of divergence, in this case, your MACD. Now, someone can say, well, if it's really going to reverse the big wave, if I measure XD at the smaller level, at the 15-minute level, it should still be indicative of a reversal. It is, it's just you're measuring the bigger level wave stretch at the smaller level, which isn't necessary. It's going to give you confused divergence at the 15-minute level. You can measure it, but it's not a good read. And we're in here, not just scans, forks, and Fibbo. It should really be the new paradigm trading with scans, forks, and Fibbos. We're in here, remember, go all the way back to the beginning. Very tight stops. That's where your profit is. You're going to make more dollars per pip with tight stops than you do with big fat stops. Now, if you don't understand that, go to the pinned videos in the group and you'll read a little bit about risk and reward and such, and it'll explain what I'm talking about in terms of stop size. So we want to trade tighter stops, and yet if you use XD at the lower level, you're actually using an upper level time frame distance to measure your divergence. And you're using the wrong indicator to do it because you're using a lower level time period. So you're using an upper level stretch, in this case of highs, but you're using lower level MACD if you're on a 15-minute chart. So that's why it gets confused, because they're the wrong time. The 15 minutes is the wrong time period to measure that. So guess what you do? Look at that. There's a CD in the pattern. Is that a swing low, swing high that's brand new? Yeah, it is. Can we do what? Pitchforks. The iMarkets Live Scans, Forks, and Fibos Facebook group. So we can draw a Charlie Delta fork on that scan, and I hope you see how it fits into the bigger move reversal. Now let me ask a question. For those of you who've been trading Charlie Delta, you know sometimes what happens. Oh, price comes down a little ways and then it goes back up. Does that make sense in terms of this channel? Sure does. What about the times when from here price goes, forget about the pitchfork, just think of the scan. Maybe if I back up one, we'll get there. How many times have you seen price do this? You know, you look at a pattern that's still on the chart, and there's price like that. It's 2 and 3 times the size of the pattern. You ever seen that? All right. That's because you're hitting this major, in this case, the end of a big wave down. It's retrace up, and now we're hitting the momentum move back down. So it all fits. All right. So now I'm going to really jump on some of you. So for some of you who are brand new or have only been trading and haven't had a lot of Elliott wave exposure, the rest of this is going to be overwhelming and confusing. But just try and follow along. Just try. Okay? For the Pip Club traders, you have some semblance of an understanding of Elliott wave because it's been in your library for a long time. For the new IML CD10 group, you're starting to learn Elliott wave. We've focused on it the last couple weeks. So, from an Elliott wave perspective, you have to understand these letters in here, in terms of the ABC, are not random. They're part of a bigger move. And if we look at Elliott wave, we can see that a big up move is a 5-wave move. And it has a correction of an A, B, and C. This is called the zigzag. The A, the B, and the C. That's the correction of that up move. So in terms of that, here's our big move. Let's say it's a 2 to 3 move. The correction on that 2 to 3 move can easily be a zigzag or an ABC. And then after that correction, guess what? It takes off impulsively again. So the ABC fits into something. When you only treat it as a 15-minute scan, you're missing the point. How do we know way up here if that's high enough to actually be the end of the 5th wave up? Because this is going to be a 1, 2, 3, 4, 5. How do we know it? We compare the divergence between the 3 and the 5, which is your XD. Yes, at this upper time period, those are the highs you want to measure because they're all essentially in that same channel, remember? They're in the same channel. We're just measuring divergence in the same channel there. When you're down on a 15-minute chart and you do XD, you're not in the same channel. You've just crossed over, I don't know how many channels. 1, 2, 3. Now you're in the 4th channel, and you're trying to use something over here in the 1st channel to measure divergence here. Wrong. Like I say, it'll work, but as you'll see why you don't want to do it here in just a second. No, I'm just showing divergence here so people understand it through and through. So again, for those with Elliott wave understanding, there's our 2 to 3 wave. We finished off some other move here, a correction down, and guess what? 1, 2, 3, 4, 5. Notice the 3-4 move is an ABC, just like you guys have learned who have taken some of my Elliott wave stuff. And so, from a non-Elliott wave perspective, how do we guess where the 5 wave is ending? In this case, it's nice that we have a pitchfork, because we're probably going to get a bounce there, especially if we had the bounce here. But without the pitchfork, how do we know where this ends? Well, we can measure divergence against that. At this point of resistance, is there divergence? Yes, there is. Oh, we're probably likely to have a reversal. So again, the XD at this time period makes great sense. So let's take that little part and let's go ahead and dive into it from an Elliott wave perspective. Again, brand new folks, don't be overwhelmed. You'll get Elliott wave in about 3 years. Don't worry about it right now. For those that have had some Elliott wave, this is just to make more sense. So we blow up the scan, and again, remember, for those that have taken Elliott wave or with me right now, we know the A move of the ABC is a 5-wave move. 1, 2, 3, 4, 5. We know the AB move is an ABC correction. 1, A, B, C. We know the B to C is a 5-wave move. 1, 2, 3, 4, 5. And we now know the correction is finished, and we're going to continue onward. And in an impulsive wave, that's going to be a 1, 2, 3, 4, 5. All right, so now here's something, again, shredder traders, harmonic wave convergence traders, you're well versed in this. So yeah, maybe 3, might be 5 to fully get it. So here's something that is important to understand. Your MACD is like RSI, like stochastics. You know, we're measuring a relative strength. And when we're on time period, in other words, as I've drawn this here, on a 240 on a 240 chart, our MACD is a relative indicator. Our RSI is a relative indicator. Our stochastics would be a relative indicator. By relative, it means it's telling you, oh, this is a top. Oh, this was a bottom. In this case, we're in an overbought situation, so we're expecting reversal at some point. But on a 240 chart, where this thing may start to turn over, on a, if you're looking at a chart that has, let's say, 50 pip chart channel, in other words, between prices, between this price and this price, it's 50 pips. On a 4-hour wave or a 4-hour move, determining that top point might have a slush zone of 50 pips. That's the degree of accuracy it's going to have. This is why when you trade 4-hour waves, you got big fat stop losses, because the slush is too big. The indicators lag, and it's not just a lag, it's a scale thing. So what happens then is, I play the harmonica. What happens then is, we drop down to a 30-minute chart. And again, it has its own MACD. And our RSI, our stochastics. they're all interchangeable with what we're trying to do here. And guess what? It also has an overbought zone. But on that 30-minute chart versus the 240 chart, that overbought zone where we might start to see a reversal might only be 25 pips big. If I drop down to a 15-minute chart, sorry, I don't have gold. I don't have gold. I only have yellow, and it doesn't show up very well. When I drop down to that 15-minute chart, guess what? Same thing. The MACD, the RSI, stochastic, it's all going to read the same. That's why these all look exactly the same, because at each time period they look exactly the same. It's a relative indicator. Relatively speaking, this is the top of your 5-minute or your 15-minute wave. And guess what? Smaller chart, much tighter box of slush, maybe 10 pips of slush. When I get down to a 1-minute chart, same thing. My relative strength indicator, regardless of what it is, RSI, MACD, stochastics. Oh gee, I'm about at the top. It looks like it's turning over. That's a 2 to 3 pip slush zone. Hope you're understanding this. Does that make sense? Do you get that? This is why smaller charts, tighter stops, bigger charts, fatter stops. So when trading, the smaller the time period, the smaller the stop. 15-minute, 1-minute. The bigger the time period, the bigger the stop. 30-minute, 60-minute, 240. Because you have to cover the areas of slush. Don't ask other people, ask me. I don't want 20 people answering trader questions. Steve, what do you mean by slush? What does he mean? And have 50 people clog up the chat. What it means is determining this top at the 4-hour level. The indicator says it's overbought, it's ready to reverse. That ready to reverse zone might be 50 pips wide or deep. At the 10-minute level, on the 10-minute indicator, or 15-minute, excuse me, on the 15-minute indicator, it's going to say, oh, this thing's overbought, it's ready to be sold. That zone where it might actually turn around and reverse, about 10 pips of slush. This is what happens, exact same price as you move down time periods. This is why when you trade 1 hour, 4-hour time periods, you have to have big fat stops to cover those slush zones. There's just no way of accurate with the tools you have. There's no way of accurately understanding that. So we talked about measuring divergence XD at the upper level on that 15-minute chart, a 60-minute chart, a 240 chart, etc. And, you can see here, based on how I drew the divergence indicator, whatever your choice, that in the move from point, I'm just going to give them random numbers, 22 to point 44, because I don't want to label them 1, 2, 3 or A, B, C, because y'all may confer that to be something else. So the high at 22, the high at 44, I just can't draw today. Actually, my palm is worn out from all this mouse work I did today. the last 3 weeks putting this together. And 66, we could see in the move from 22 to 44, which is the X, there was no divergence. So it says, probably going to continue onward. In the high from 44, which is X, to the D at 60, now we have divergence. Strong likelihood of reversal. But this XD measure is at this level. What brings precision to it, in this case, is our fork. Just bear with me, it's going to come together here in a second or two. So, upper level divergence, the X to D divergence, doesn't really matter if you're measuring on a 240 or 15 minute. Does that seem in contrast to what I've been saying? No, not, just bear with me. Yes, in this case, we're seeing divergence. Doesn't matter which one we're measuring this on. However, from a trading perspective, see, this is just the chartism perspective. Is there divergence there? Yes, there is. Doesn't matter whether I see it on the 240 chart or I'm looking at the 15-minute chart. Divergence exists. That's a chartism, meaning that's what exists on the charts. You have to understand what you trade is different than what's on the charts. Sometimes you agree with it, sometimes you don't. Meaning how you trade that chartism is what you have to think about. And so now let's look at why we wouldn't, from a trading perspective, want to measure the XD on a 15-minute chart. Got myself interested. All right, so let's talk about that pattern. And we said in reality the XD is a measure at an upper level. When you measure the XD on a 15-minute scan, so this is a 15-minute scan, when you measure it using the XD, the scan is 15-minute, but you're measuring the highs at the upper level. Now we just did something, so hopefully some of you have created the bridge in your head and understand where this is going. If you have your 15-minute scan and you're trading XD on the 15-minute chart, you're really measuring, in this case in an up move, the highs at the upper level. So let's look at this. Here's our entry line. I'm using XD to measure divergence. And oh, look at this. Price is going up from X to D, and my divergence indicator, again, whatever you want it to be, let's call it MACD. My divergence indicator is going down. I have divergence. Yay! Wait a second, it's before the entry. What does that mean? I got divergence, but we're not at the line yet. Does that mean this is the point of reversal? Forget the other criteria right now. I'm just talking those that would trade divergence. What do you call that? If you see an entry line on the chart and you have your D get to a point and it shows divergence, wait a second. That should be a trade entry. Kind of curious. Well, guess what? An hour and a half goes by. Oh, look, the D repainted. Interesting. I'm using XD, which is what? An upper level high measurement. Well, at this new high, let's just call it D1, because this was actually our D down here. Well, let's look at divergence. Prices continue to go up. My MACD has gone up a little, but it's still divergent. Here's our 0 line. I still have divergence. Well, this is a trade. That's the, divergence, yes. Wait a second, I thought we had divergence here. And so, here we are right at the entrance line. But you were in the shower, you were having a romantic dinner, you finally get back to the charts an hour and a half later. Oh, look at that! That dang D is repainted again. Now we're up here at the third D. I guess this one should have been D2 instead of D1. There was our original D. Well, let's look at divergence. Price is still going up. Well, the MACD is still going up, but at the time we're looking at this high, it's still divergent compared to the 0 line. I still see it. It's still divergent. So you tell me, which one of these was the trade? This happens because you're on a 15-minute chart using upper level wave highs. Upper level wave highs. You're measuring the wrong highs. And so it ends up when you have this kind of thing, when you're measuring D like this and it keeps repainting on you, what's happening there is you are just feeling the effect of the bigger slush zone of the 4-hour wave or the 1-hour wave. Because that's what you're measuring the highs from when you go from X to D. So you're forcing a slush zone in here for where all of these would be valid reversals in that zone. Because at that time frame, at that upper level time frame, you would have a stop loss that would accommodate this slush. So if you entered here and it went to here and it went to here, no big deal. So look, if you want to trade X to D on a harmonic scan, it's okay. Just use the stop loss printed on the chart and make 1/10 the profit, 1/15 the profit. If you want to trade with your 10 pip stop loss on a 15-minute chart and tighten this zone down, then you want to measure the actual highs in the channel that you're at on time period. Ooh, ah. That's why I say the X to D, oh yeah, it's valid, you can use it, but you're measuring the wrong time period highs. And you're going to end up with a slush box. Now you might be saved by 15-minute Bollinger Bands or 15-minute overbought, oversold in RSI. That might save you. But if you want an understanding of what's going on with divergence, here it is. When you measure these, you're measuring upper level time period highs. And you're trying to find divergence between those two, which isn't right for 15 minutes. So, my final word on divergence. The XD is an adequate way to measure, but it's going to have more slush and slippage and more chance of the D sliding into the exhaustion and after the exhaustion, which may give early entry or create a stop out. The best way to measure is in the CD channel. It's going to have less slush because you're dealing with a lower level wave. And guess what? The slush is accommodated by your 10 pip stop loss. It's going to have less slush and less chance of the D sliding into the exhaustion and after the exhaustion. And when it does, usually does so within the 10 pip stop. This method will give you more chance of establishing the true D in tighter space. Now, no divergence is ever right or wrong. It's never, let me rephrase that. No divergence is 100% correct. It's right most of the time. A divergence reading is wrong some of the time, which is why in quickfire there's multiple criteria. But if you measure X to D as your divergence, it kind of defeats the purpose of being on a 15-minute chart. A totally off Forex example. Which is more accurate, your local weatherman's 1-day forecast in the next 24 hours or your weatherman's 7 to 10-day forecast? Which is more accurate? Now here in Central California it's pretty easy. Like in July, August, they just say 110 and paint it out 10 days and they're 99% correct. But I'm speaking in seasonal areas. For the most part, your 24-hour forecast is going to be much more accurate than your 10-day forecast. And what you're trying to do is determine whether you need to wear a coat or bring an umbrella tomorrow based on a 10-day forecast versus the 24-hour forecast. So again, the XD can be used. Now, for those of you that were trading, 60-minute, 4-hour, even 15-minute, and you want to use XD, as I said, you can. It's just you're going to need that time, that stop loss that's printed on the chart. You're not going to be in there with a 10-pip stop loss because you're measuring the wrong period highs for your divergence. So remember these legs, remember these channels. You want to know, as we're pushing up to D, which of the highs is the right one to bring me closer to being the right one. Okay. So right before we started, and I mean right before we started, like about at 8:45 Eastern, I went to the scanner and I pulled off just like the first 5 or 6 that I looked at. And so here's a case. Now again, don't use any other criteria. I just want you to look at divergence. So here's one where the red is going to be your XD measure. And in this particular case, in the XD, there was no divergence. ICD means inside the CD. Inside the CD leg. Inside the CD leg, we followed the last couple of highs up, and oh my, last couple of highs, we have divergence. So here's a case where the XD doesn't even give it to you, but measuring inside the channel does. Ooh, ah. All right, here's one XD in red. No divergence, and inside the channel, remember we're measuring bottoms on the down move, we're going down, there was no divergence here either, which is probably a good reason why this whole thing well overran. It's a shark, but it well overran it. All right, so here you have another one. Now this is a shark too, but guess what? XD, there is essentially no divergence. This RSI is, still pointing somewhat down. In terms of the ICD, inside that channel, we have divergence. Pointing down, MACD pointing up. Okay, here's another one. XD, both of them, price is up. RSI would have been slightly up as they would have measured it. What do we see here? in the ICD, internal to the CD channel, we're measuring lower lows. We want to compare this low to the previous lows, and there's a whole bunch of them essentially on a trend line. And our divergence is going up. So we have divergence here. So here's, the first 4 or 5 I looked at, there was one where they agreed, and I think the other 3 or 4 they disagreed. And every time the trade went with the divergence on the CD channel, there would have been a no trade there using the XD. All right. So let me go back one. I'll put this up in a second for everybody else. Are there any questions? It's really pretty simple, guys. Just understand that when you're looking at the XD, when you're looking at a pattern on a 15-minute chart, you're looking at swings. If you look at the entire pattern, you're looking at swings that are inside an upper level wave. And to measure the XD, you're measuring those swings. In this case, it's 2 swings down. When you look at it from the pure 15-minute level, there's no, oops, passed it. There's no way you can misconstrue this. There are, 4 channels. And, what's happening with the B or what's happening with the X is not relevant to what's happening in the CD channel. The only time I'm trying to compare the D to the X to see divergence is if I go up level. And then when you go up level, what happens? You introduce slush in that measure. We want to keep it low. To keep it low, low slush, you want to measure inside the CD channel. Now, I have one comment here. No, I'm not going to do the setup again because that's part of quickfire, and this isn't a quickfire training. This is a training on divergence. So all of those slides on the setups and the techniques and the criterias and the various entry mechanisms and the various money managements is fully contained in this quickfire Charlie Delta training video, which is in the pinned post at iMarkets Live Scans, Forks, and Fibos. So in here, see, some people have come to me and said, well, there was another educator who said we should measure from XD. And, that's okay. But for the most part, those trades weren't using a 10 pip stop loss. They weren't precision entries. So if you want precision entries, then you need to measure inside that Charlie Delta channel. Look at that, man, 1 hour and 10 minutes. That's what happens when you come with prepared slides. Well, I'll just go back. I'm not going to show another. I'll just go back and show you the ones that I did. You're just measuring inside here. You've got to move from C to D. Let me make it a little flatter so it might make sense to you, as if we come way down on lower time periods. I've got a channel that looks like this. This is the CD move in its entirety. Remember, the B's over here. It's not relevant. There's the BC channel. This is my CD channel. What am I looking for here? I want to know when this channel, the last one in the patterns, is going to reverse. And what that means is, if I have a whole bunch of waves going up and down and up and down and up and down and up and down and up and down, that's nice to see after the fact. But when it's real time, and all I see is this much of the chart, is that a reversal or not? I don't know. No, if I measure divergence, it doesn't show me divergence. When time moves on and that's what I see, is that the reversal point? Is that divergent? Yes or no? How can it be divergent? You have to measure it to the previous high, right here. So as we keep going up, we're always going to measure the strength in this compared to the strength in that move. It's always back. This is the short-term divergence. I'm in the CD leg, so I'm measuring these points. So what that really means then is, in terms of line drawing, I'm finally up here with the D. There's an entry line somewhere close by. I want to measure this point to the previous highs. That's why I draw a line like that. I want to measure these highs. Excuse me. And then from a verticality standpoint, I want to measure the same point on my MACD or my RSI or whatever it is I'm measuring on my RSI. So that length of zone. What's happening? Way many scrolls back up here at the X. It has nothing to do with the strength of this high versus this high. And that's what I want to know, because I want to know which one of these is going to be the reversal. Again, it's relevant to look at this and this, but only when we're at the upper level. If you want to do that, then you have to have a big fat stop loss, because as I've shown in this, watch this again. This is the reason why I went through so much trouble. If I spent 4.5 hours building it and I spent an hour and a half teaching it, which is 6 hours, you can surely watch a 1-hour video twice. Go back and watch it again. There's a big fat zone of slush when you're using the XD on a 15-minute chart. Repeat, 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 repeat. Yeah, Zoe, thank you. 14 years of prep. So I've covered that. If you want big fat slush, meaning big fat stop, then use the X. If you want precision trading and you want to get in here with a 10 pip stop loss, use the CD channel and these progressive highs. Or in the upside down, in a bullish pattern, use the progressive lows to measure your divergence. As promised, I will put the group information up one more time, and I'm going to close it down unless there's any big questions, because I want to keep this as short as possible so we can indeed create a video that's not too long, that it can be watched several times, an hour and 15 minutes at this point. All right, so with that, I'm going to call it a night. All my other sessions were closed this week, but I came and kept the IML session for tonight. I won't be here Wednesday. It's U.S. Thanksgiving, most traveled day of the year. For me, I'll be cooking most of Wednesday. So hopefully you got divergence down now, because all I'm ever going to do when anybody asks about Divergence, whether they're asking me or putting it in a group, I'm just going to say, go see the Divergence video. So it's done. So the investment, while I'm joking about it, well, I'm serious, it was that long, but while I'm joking about it, understand it's not just for tonight, it's for the next year or two. I'll see you guys a week from tonight. Have a great evening.